Mortgage rates have declined for the fourth week in a row. This means that mortgage rates and borrowing costs have reached their lowest level since mid-September, according to data from the Mortgage Bankers Association. So how does this impact the housing market? Well, let's jump into the details and get to the bottom line. Good morning. Lots of great information to go over with you today, but let's start with some of the staples. The average 30-year mortgage interest rate was reduced to 6.41% last week, which marks the fourth consecutive week of improvements to mortgage rates, according to the Mortgage Bankers Association. And on the application front, the MBA released their data, which showed that week over week, mortgage applications declined by 1.9%. In other news, we are starting to see or continuing to see signs of a recession. The spread between the 10-year and the 2-year Treasury now stands at a negative 81 basis points, which is the deepest inversion since 1981. The 10-year and 3-month spread is now at negative 76, which is also incredibly deep. And even though you might not understand these inversions, what's important to understand about them is that they are a very reliable indicator for when a recession is going to happen, especially the 10-year to 3-month spread. And so on that note, we have a special guest here today. We've got Justin Small, who's a production manager here at X5. And Justin, why don't you tell the viewers a little bit more about where we stand with unemployment and how that is relating to the looming recession?
Thanks, Jake. I appreciate you having me. So let's dive into the unemployment. So there is a huge gap between the business survey, where the headline job creation figure comes from, and household survey, where the unemployment rate comes from. In October, the business survey showed 284,000 jobs created, while the household survey was down 328,000. Then in November, the business survey was up 263,000, while the household was down 138,000. So over this 2-month period, the business survey showed 547,000 jobs created, while the household survey sunk 466,000. This is over a 1 million difference. Such as a gap in 2 months has occurred less than 1% of the time in the past, and the data goes back all the way probably more than 70 years. Previous times were winter of 2020, spring of 2007, summer of 1981, spring of 1980, spring of 1960, and the spring of 1953. All of these were the years when recessions occurred. However, it is good to keep in mind that the housing has historically done quite well during a recession, and it's important to understand that there's a very big difference between a recession, which is normal in the cycle of the market, and a housing crisis like we saw in 2008. So hopefully this gives you some great insight on what's going on and kind of where we're at in terms of the market.
Yeah, great stuff, Justin. Thanks so much. And to reinforce that point too, we got some data from CoreLogic, which released their home price index for the month of October, and that showed that home prices only declined by 0.1% and are still up 10.1% year over year. Now, this is a revision, a decline from their previous projections of 11.4% year over year appreciation. However, during the time of this report, interest rates were at 6.5%. And home prices hung in there pretty well. Now, CoreLogic also forecasts that home prices will remain flat for the month of November. However, they project that they will increase 4.1% in the year moving forward, which is actually an increase to their previous report, which projected only a 3.9% increase. Now, this is important because although we're seeing slightly negative readings on the month-to-month data, experts are still forecasting that on a nationwide average, we're going to see over 4% appreciation. Now, keep in mind, real estate is a local business. So we're going to have certain real estate markets where there's less than 4% appreciation, and we're going to have certain opportunities in certain markets where there's more than 4% appreciation. And really, the determining factor in being able to take advantage of that opportunity is going to be having an expert real estate agent that you're partnered up with that knows and works and lives in the markets that you're going to be shopping for your next home in. So like Justin alluded to, we are almost definitely in or maybe heading directly towards a recession. But we feel strong that housing should remain strong and even continue to appreciate in the face of this recession. Now, to be totally fair, we've never seen the current situation that we're dealing with in the market. There's been nothing quite exactly like that in the past. And so we'll continue to keep a very close eye on this data and the different metrics that you'll need to keep an eye on to stay as an expert in this field and navigate your clients or your own life. So we appreciate you tuning in here and taking a couple minutes to watch this video, and we look forward to catching up with you next week on The Bottom Line.